Thank you for watching Resource Talks. My name is Antonio, and I'm here together with Luke Tenhava. Again, it is the beginning of a new week, so it's time for some junior mining talks. This time, we're also joined by Matt Geiger, who's a portfolio manager and the founder of MJG Capital. But before we get into all of that here, Matt, there's a note that Luke and I would like to make. There was some information in last week's video with Michael Gentile that may not have been clear for everybody. Specifically, one of the charts that we showed on the screen, it showed Michael Gentile's insider and reported positions, and that chart contained outdated information. So the holdings shown on there were not necessarily true in their form today or on the day that we showed it. But Luke, I mean, it was. I think you do a better job than me explaining it. So why don't you take it away?
Yeah, so what we did show during the interview with Gentili was a list of his holdings. And there's two sources where you can find those things. CDI, where insiders are required to file their position, and of course, companies announcing it in a news release. If somebody stays below 10% of the shares outstanding and is not becoming a director, then you are not an insider, but you can still be mentioned, like, hey, Gentili owns 9.9%. But of course, that could be outdated in a very short period of time. And what we did is I showed in that list all the positions that Gentili was reported in the last 5 years, also the ones that he's no longer required to file. So there's probably a number of names there, company names, that are no longer in his portfolio, or maybe not with the number that we showed. We did show insider yes and no, and director yes and no, and the date when he last filed, but it caused some confusion, and that's why we want to retract that image and just show the image that where we know it's correct, and that's why we want to make this statement.
I think it's also kind of important here is, I suppose, read the fine print. Changes happen quickly, often in the market, and oftentimes that's not something that is broadcasted again, especially if it's not an insider position or something like that. And I think you had mentioned it on top of the chart, as well as again the date on here. So yeah, that's the important part. We can get into the actual interview now, though. But of course, not before I've warned everyone listening that although none of the companies mentioned or featured in this publication have paid us to talk about them, this channel earns its money by charging junior mining companies for interviews. This means that there is a high probability that some or all of the companies that we will cover in here have paid us in the past or might pay us in the future to conduct such an interview. In addition, all of us are active junior mining speculators, which means we may own shares of companies mentioned in here, or we may have owned shares of them in the past, or we may own them in the future. Please read the disclaimers on your screen right now. And if you're new to this space, please go to the last portion of this video and listen to that warning first, because your capital is at risk. This is a very, very risky sector. But that all said, a lot of stuff on the planning here today, not so much time. So I'll just kick it off by thanking you. Thank you for being here, Matt. How have you been? How's life? How's business? How's the portfolio? Talk to me.
Hey guys, thanks for having me on the program. Good to be with you. Things are good, but very busy. I was just able to get the MJG partnership letter out about a week and a half ago, and that's always a labor of love. A little bit of a respite here before a busy travel schedule that begins next week. Have 4 conferences coming up in the next 90 days. We'll maybe try to fit in a site visit as well over that period. So I've had a good 2 month period of no travel. So I'm reared up and ready to go and hit the road.
Good point on the site visits. I have a question about that because I hope I can do some of that as well this year. So we'll talk about it. But let's maybe kick it off kind of high level and drill further down from there. And I'll just go through your start with the performance of that letter that you mentioned, your investor newsletter, which is dated December 31st. 6 month performance is on here, but by the way, as well. But I just don't generally think that makes too much sense to look at specifically in venture capital, specifically in junior. So I'll just ignore that. Go to the 1 year performance. You had a positive year last year, so 6.7%. Let's call it 7%, just because I like your smile. But the TSXV did over 8%, and I don't like its smile at all. Whereas the S&P did 25%. So you haven't lost money, which is an accomplishment in and of itself in the junior mining space. But with Luke's Resource 100 website, by the way, told me that the sector had a negative 2% or so performance in 2024. But you're also not outperforming the broad market with the S&P. So what happened last year? What do you think influenced your performance the most?
Yeah, 2024 was a frustrating year. There's no doubt about it. The year was really characterized by strong outperformance by the two what I'd consider bellwether metals, copper and gold. Gold, of course, was up 27% over the course of 2024, which was its strongest annual performance dating all the way back to 2010. And copper, even though it ended the year up only 8%, for large portions of that year, really strong price action there, reaching a all-time high of around 520 per pound in the spring period, and even as recently as the early October period was up at 460 or 470 per pound before fading pretty significantly into the end of the year. So I would argue quite positive price performance for the key metals, but it really was a story of the mining equities just failing to keep pace with these metal price moves pretty much throughout the whole course of the year. On the precious metals front, we did start to see some of the major producers and kind of the blue chip names start to rally, pretty decently into the summer period and into the early fall. But on the junior end of the market, we're primarily focused. Our median market cap for our 17 positions at the moment is around 45 million Canadian as it stands. So we're definitely playing in the junior end of the sandbox. It was more been pretty much across the board for the course of the year. There was a 4 to 5 week period from late September through late October where it really did look like we were on the cusp of a breakout. I know, speaking from the MJG fund's perspective, we were up, low teens, kind of in that mid-September to late September time period. Before, in that 4 to 5 week period, we were up over 30%. And I was feeling pretty good. I was excited to announce good year-end results to partners and kind of end the year on a high note. But then the Newmont earnings struck Thursday, October 24th. That date is ingrained in my head. Really threw a wet towel over the whole sector. And then that was followed roughly 10 days later by Trump's re-election in the United States, resulting strength in the US dollar, tariff concerns and the potential implications of tariffs on metal demand. And yeah, November and December were a bloodbath, put simply. MJG fund drew down from the 30% range year to date down to 7%, as you mentioned. I mentioned this in the investor letter. The GDX was up 43% at its peak in late October before ending the year up 9%. The GDXJ was up 47% in late October before ending the year up 13%. The COPX, the ETF that's comprised of the world's largest copper miners, was up 30%. A little earlier, that was early October, 30% year to date, ended the year up 2%. So it really was a broad sell-off into the end of the year. And I think it caught a lot of folks off guard. If you had told me going into 2024, if I had a crystal ball and I was gazing into it, and I was to be told that the gold price would appreciate by 27% over the course of the year, and B, that there'd be significant mining M&A, particularly in the second half of the year. I mean, we saw more M&A last year than we've perhaps seen in over a decade. I would have anticipated returns that were closer to the 113% that the MJG returned back in 2020, and not the lackluster mid-single digit return that ensued. But alas, yeah, we soldier forth. I will say, hope springs eternal, and it has been a very positive start to 2025 that we can get into. But yeah, that's kind of how 2024 played out from my perspective.
Alas, we soldier forward, armed with the knowledge that the mining sector has now been starved of capital for the better part of a decade. If this thing doesn't work out, you can always be a poet. I can tell you that much. And
thank you, Antonio.
you say, I quoted that out of your investor newsletters, you would know, but then for people, they probably have it on the screen and caught you off guard, caught all of us off guard. but then again, I've never even had a guard to begin with, so everything catches me off guard. But this is a question. Listening to you and listening to how it kind of wiped away your ability to maybe enjoy the end of the year there. I often ask myself, even though you did a whole lot of work, and I often ask myself this, especially when it's 4 a.m. and I'm looking into the mirror, but it is a sector really worth it? I mean, you're one of the few people who I would consider to know what they're doing. And this time I'm not just saying it because I like your smile, but so I mean, your 10-year performance, even though very good, it's about 210% total return. That is, so the Geiger, that's 12%. It massively outperformed the venture index, which is actually down in that period, but it still lags the S&P, even though, again, go back, read those investor newsletters you've published through the years. You've thought deeply about how you allocate capital. You've always had a thesis supported by good analysis. You do site visits. You go to these conferences. You talk to managements. You avoid the obvious red flags. You avoid those. You do what you can do realistically, and probably way more. Yet just the S&P, call it the most obvious index, if you will, in the world, does better with arguably less counterparty risk, and it would have taken you way less work to just buy that and forget. So how do you justify staying in a sector like this that is hard even for the professionals like yourself? And then I'm thinking, is it really worth it for the aspiring amateurs like myself?
Yeah, fair question. Yeah, and I will say the end of 2024 was pretty psychologically difficult, even for somebody with me who already has a lot of scar tissue. But yeah, this is the game that we've chosen to play. And look, the past 16 years, really since the great financial crisis, has been characterized by tech dominance. It's been characterized by large and mega cap dominance. It's been characterized by dominance of the United States over the rest of the world. So it's very hard to swim against that stream. My view is that is shifting though. Timing uncertain, but I feel quite confident. I'm not sure what's going to happen over the next 12 months. But if you're looking 5, 7, 10 years out, we're going to see the pendulum swing back in the other direction. We're going to see outflows out of the United States into global equities. We'll see a shift from growth mentality back to value. We'll see a shift back from passive investing, which has absolutely been the flavor of the month for many years now, back to active management. And we'll see the pendulum swing back from new economy, high tech, cryptos, AI, all the stuff that's capturing the active imagination of current investors, back to the old economy. Because at the end of the day, this is a cyclical industry. That's the way it's always been, and that's the way that it will continue to be. And if you starve an industry that's essential for the functioning of humanity, of capital for a 5, 10, 15-year period, we're getting close to 15-year period since kind of the peak of the last mining bull market. Eventually that comes back to bite you, at least from a societal perspective in a big way. And for us investors, we can capitalize on that. So I view this as a coiled spring, and the longer the pain goes on, ultimately the more dramatic the move will be on the upside when the worm ultimately turns.
In September, you had an interview, I think, at one of the conferences, and you said something like, "I feel no rush for gold to go higher because gold did so well," and you was kind of hoping for some consolidation in the gold price. And since then, gold went from 2,600 to 2,900.
Yeah.
Juniors did, as discussed, quite poorly. Right now, doing quite well, I guess. Do you feel there's a bit of risk there too, that gold is at some point going to correct and it's going to take everything down as well? Or is that, is that a realistic thinking process?
Yes, I mean, ultimately, I want this move to be as long and drawn out as possible. Like we've all experienced the sugar rushes of 2020 and 2016, and those were fun while they lasted for the 6 or 9 month period. But the way for real wealth to be created in this space is through a sustained bull market over multiple years. You're right. I mean, one could argue gold did consolidate a little bit there. It ran up to 2,700 and pulled back, a couple $100 on Trump's election. But yeah, we did not see that 6 or 9 month consolidation period that I had talked about at that conference. We're back off to the races with gold at an all-time high. I mean, one interesting factor we're seeing is that at least the larger producers are outperforming at least year to date. Like if you look at the GDX, GDXJ, they're both up over 20%. And there are a lot of producing miners out there. Just pick your name and look at their year to date performance that are up over 30% year to date. So to me, it's exciting to see the outperformance potentially occurring that one would expect to see. I mean, metals historically, it could be different this time, but historically exhibit leverage to metal price increases. The miners do, and usually 2 to 3x in either direction. We did not see that last year, but with gold at its current levels, you could argue that the disconnect between the gold price and where the precious metal equities are trading is larger than it's perhaps ever been, certainly in my lifetime. And so there's kind of three outcomes that could occur. The first is that the miners play major catch up, and that's kind of my base case. I think that is the most likely of the outcome. The second is that the miners are sniffing out that this gold price isn't sustainable. That maybe touches on your question, and who knows, maybe we do see gold back at 1,800 a year from now. I don't anticipate that to occur, but it's within the realm of possibility. And the third option would just be that it's different this time, that gold can just continue to run in perpetuity without the miners responding. And I think that's the least likely of those three kind of scenarios. But yeah, it's, one thing to note is, gold is one metal. Maybe some listeners of your program here are 100% focused on precious metals. But in terms of the MJG fund, gold is, I think, 17 to 18% of our weighted portfolio. If you throw silver in there, throw the PGMs in there, maybe 35% of our portfolio is weighted to precious metals at the moment. But that leaves a whole host of other metals and companies focused on other commodities that we have exposure to. Copper being the most significant of those at roughly 36-37% of the weighted portfolio at the moment. And I just should note quickly on the copper front, at least in recent history, we've seen copper often follow gold with maybe a roughly 1 year lag. That was certainly the case back in 2020, where precious metals rocketed from the spring really through the end of that year, at least early Q4, where 2021 and into 2022 was really the period of copper outperformance. And I should note that the gold price had its major breakout in March of 2024. So roughly a year ago. And so if we see history repeat, this next year could see outperformance of copper over the price of gold. I'm definitely open to that scenario. And we're also seeing the copper to gold ratio at levels that have generally marked the bottom, at least over the past 4 or 5 years. So again, I wouldn't mind at all for gold to take a breather here, even if it's for a 6 or 9 month period, and let the rest of the metals complex play some catch up. But obviously, my wish is irrelevant for what ultimately happens.
You're starting to sound like Rick Roll, so I like it. But you can keep saying that you want it to go down, because when you say it typically goes up. So you can keep coming back every month and keep saying
there we
that.
go.
What cash and cash equivalent 0%? Your report says you're fully deployed right now. I mean, how do you justify that from a risk reward perspective?
Yeah, that's a big change from where we were in late 2023. In late 2023, we were at a double-digit cash position, kind of the 12-13% range. And if you think back to that period, and maybe some of the listeners here weren't even in the space at that time, that was a really rough, despondent period, particularly from a sentiment perspective. One could argue even worse than what we experienced in the November, December time period that we just went through. So in that 3 or 4 month period, Q4 2023 into January 2024, we got very aggressive and deployed our dry powder into 4 different deals over the course of that period, and went from the double-digit cash position down to close to 0%. And that's largely where we've sat for the past year. Of course, we cycled out of some names. I think we liquidated at least 4 names in the portfolio last year. We added a couple investments last year, and also did some averaging into at least 6 of our positions in the second half of the year. So I have been active. But yeah, for the past 12 months, we've been in a kind of a fully deployed stance. And I would like to think that that will serve us well going into 2025. I think it will, unless there is a broader market breakdown, a true liquidity, event similar to what we saw in 2020. And if that does occur, which is certainly within the realm of possibility, then the fund will take it on the chin. But as of now, I'm quite comfortable being fully deployed.
When you write a big letter like this, I mean, it also requires you to think, and of course, that's part of your work in general, but to really think about what you're doing and write it down. I mean, you really have to spend time in explaining what you're doing. And there's two questions here. So one is, how do you deal with lessons learned? I mean, do you look at the last year, the last 2 years, and think, I should have done this differently? And the second part of it is, and I have experience with that myself, is when you sort of get used to the new market environment, which I got used in 2011, 12, 13, 14, 15, to every run of 50% is followed by an even bigger crash. So in 2016, I started selling in March, or maybe even in February already, because I saw a couple of stocks go up, and my mindset was so much like, okay, we had a big run again, or a small run again, let's just sell, and then it just continued. So is it also dangerous to have lessons learned? Because if the market sentiment changes, maybe those lessons are no longer valid anymore to the market dynamics.
That's right. It's easy to overlearn the lessons of the very recent past, and that can cause you to miss out kind of on both sides of things. And there's a lot of data out that recent market performance actually changes the physiology of our body, which is pretty fascinating. I read a book recently. I believe it's called The Hour of the Wolf, and it was a really good read. Or sorry, the Between the Dog and the Wolf was the name of the book, and yeah, to discuss how in bear markets, the amount of cortisol that gets shot into the body of investors, and how that makes us much less, we're very risk averse and disinclined to take risks, even if there are exciting opportunities. And of course, conversely, towards the top of bull markets, the amount of adrenaline that gives us a major sense of overconfidence. So I think it's very difficult, and that's one of the lessons of the book, to actually change that physiology. It's going to happen either way. But at least if you're aware of it, you can stick a pin in it and try your best to remind yourself of how this is a common occurrence across all investors, and try to keep as even as a mind as possible. So point taken there. Yeah, in terms of lessons learned, I mean, we were up on the year, so having a larger cash balance last year wouldn't have helped us to any degree. So I'm comfortable with the decision to have been fully deployed over the past 12 months. There's certainly individual positions and kind of how I handled given circumstances that I look back on and reflect on and try to take lessons going forward. One example that comes to mind is Bravo Mining, which is a company I very much have conviction in. It's one of our largest positions within the portfolio. But they announced a very exciting discovery hole of IOCG copper on their Luanga project. This was in late May of 2024. And on the back of that discovery hole, share price doubled in very short order. And I got swept up in the excitement. And in hindsight, it would have made sense to take some chips off the table when that share price was trading north of $4 per share. We didn't, and it's since gone right back to the level that it was before that discovery. I'd argue that there's still quite a bit of IOCG potential on the Luanga project. Interestingly, Vale owned this project previously and had written off any IOCG potential at all. So Bravo has proven definitively that there is potential for IOCG mineralization and potentially a significant deposit on the overall land package. But T5 in itself failed to live up to that initial discovery hole. And, we're right back to where we were beforehand. And in hindsight, I certainly wouldn't have sold a significant percentage of the position, but even at the margins, if we taken 20, 25, 30% off the table when it was north of $4, in hindsight, that would have been the right move. So anytime that I initiate a new position, I have a journal basically, or an Excel spreadsheet where I'll go through, talk through the net rationale of why we're initiating the position, make a point of noting the exact thesis that we're investing in, because it's easy to get kind of mission creep as an investor. And so I make a practice of going back to those original postings and trying to keep in mind why we're in the name and whether that original thesis still holds true. And if it doesn't, more often than not, it's a good time to hit the exit.
I think selling in general is more difficult than buying, right? Because we all have, I mean, especially people who have been in the industry for quite a long time, you have these success stories in mind, like the Great Bears and the Philos, and there will be more of those stories for sure, but not many. Every year, just 2 or 3 of them or 4 of them that start their move and do this over a number of years and have a very successful ending. But most companies, even the ones with good news, sort of end in not such a good, with such a good outcome. In terms of selling, do you think that makes also a difference to, I mean, thinking and hoping that we all invest in these non-revenue generating. Well, you do also have royalty companies, but most of it I think is non-revenue generating. So it's sort of a
80%.
thesis of finding something, and hopefully finding something so amazing that the thing keeps going and somebody will take it out. Is that wish for that outcome that everybody's trying to find maybe so big that selling becomes difficult because you feel like, I don't want to miss out of this. If it becomes big, I want to be in it. I don't want to be out of it. And fear of missing out keeps you in the story maybe longer than you should. Is that part of, do you feel like that's part of your thinking process as well when you look at your positions?
Yeah, as I've grown as an investor, I've become a little bit more comfortable, and it can be a challenge. Everybody, of course, wants to sell at the top. That's the dream. But I think it's better to be approximately right than 100% wrong. And I do not suggest for folks to have, mechanical or automated selling processes. The stock doubles, immediately take half off of the table. But I do think there is merit if a position's performing very well, getting closer to what you view as fair or expected value for that given name. I think it's okay to take chips off the table. But also to your point, I wouldn't be so, especially in this space, I wouldn't be so rigidly devoted to valuation that you automatically liquidate your position right when it hits your deemed fair value, because positions names can rocket well beyond what you deem fair value. So I'm more of a gradual seller in that perspective. I guess the key variables to look at would be fundamental developments on the company level. Maybe the drill results that have been driving the share price rise are starting to peter out, or the market's not reacting to them as much as they were previously. Maybe you're seeing insider selling or significant shareholders taking money off the table. That's almost certainly a sign for me that I should at least lighten up on the position, if not get out of it entirely. So there's the fundamental factors to look at. There's also the factor I just mentioned. What do you think fair value is? Where is the current price relative to that? And unless there's a step change in fair value based off of a significant fundamental development at the company level, the higher the share price goes, the less attractive it is, both on an absolute level and also relative to the existing holdings in your portfolio. So that would be another reason to take profits. And I guess a third would also be, your current portfolio construction. If the name is just so outsized relative to the rest of your positions, it can make sense to gradually take money off the table. Or if it's resulting in your portfolio having more exposure than you're comfortable with to a certain jurisdiction, to a certain business model, to a certain target commodity, that could be another reason to lighten up on the position. But I try not to make binary decisions where we're all in and excited about a name, and then the next day the price goes up 20% and then we're fully out, game over. I'm comfortable with being approximately right. And in cases where you do see that shark fin chart formation, which happens more often than when we'd like, taking profits gradually give you leave you in a better position than if you're waiting for that perfect exit point and it never arrives.
What is fair value, though? I mean, that's something that bugs me a lot. Like, is a $140 million pre-drill, $140 million market cap pre-drill company, is that fair value? Or a pre-MRE company that's got $1 billion valuation, is that fair value? And like sometimes it can be. So how do you deal with that? How do you deal with the concept of fair value?
I think as an investor, you have to do your absolute best to estimate it to the best of your ability, even understanding that it's approximate at the end of the day. And I would argue the earlier stage the company, the harder it is to nail down anything close to what fair value is. But if you look at a production stage name or a royalty company, fair value can be approximated based off of relative valuation, so how the companies are valued relative to peers, and what would have to happen from a share price perspective to it reach the mean or the median of the peer group. So that's one aspect you can look at. You can look from a sum of the parts perspective, value if it's a multi-asset producer or a royalty company with multiple royalties under one roof, value each of those assets individually, and then come up with a combined value for them, and then see how that relates to the current share price. If there's a significant enough delta, then there could be an opportunity there. So it's easier with the names that are cash flowing. If you kind of move down the value chain a little bit and look at the development stage names, I think the best way to go about it for projects that have economic reports that are already public. First, you got to examine the assumptions and make sure that the numbers remotely resemble potential reality. But if you have that level of comfort, then you can discount that NPV based on the stage of the project. Less of a discount for a feasibility level project, more of a discount for a PEA. And you can determine what those discounts are based off of the discounts that peers are receiving, or just kind of rough rules of thumb. I would say very generally, very, very generally, you'll typically see a 90% discount for a decent project that doesn't have screaming economics, but isn't an absolute non-starter either. See a 90% discount at the PEA stage on that NPV. Pre-fees, maybe an 80% discount, and then feasibility, maybe a 70% discount. So that's like very broad stroke numbers. But that's how I go about thinking of valuation and what potential fair value is for a project where there is an economic study for you to work off of. And then, it's a bit of the wild, wild west when you get down to the expiration stage. That's definitely more of an expected value calculation versus what I would describe as a fair value calculation that we just discussed. We were basically looking at what the potential size of the prize is, based off of value in a best case scenario, or based off of comps that you've seen for similar expiration stories, and then adjusting that based off of the probability of success, discounting that upside scenario based off of the probability of success. Difficult to do, difficult to define expected value with any significant degree of accuracy, but I think it's important exercise for an investor at least to attempt for these types of companies, and to continue to reevaluate as more and more data comes out on the project and from the company. And then I would just briefly talk about prospect generators here, because they are a significant percentage of the MJG portfolio. When I think of valuations there, personally, I use a relative comparison. And we have an internal model at the MJG fund that tracks, the roughly 40 prospect generators that are active within North America. And one relatively simple metric to understand, it's a little bit harder to track down the data, but is basically looking at the company's enterprise value. How much is the company, or is the market valuing the company at? And then comparing that to expected partner expenditures in the current year. And the higher that ratio is, the greater the partner expenditures are relative to the enterprise value, the more bang for your buck you're getting ultimately for every dollar of value that you're assigning the company. And if you do that across the 40 different prospect generators, you can then look at the distribution, and there's some names that look really cheap from that perspective relative to their peers, or some names that look quite expensive from that perspective relative to their peers. And that can at least be a starting point for you to dig deeper into a story. And I don't suggest that somebody go out and immediately buy a prospect generator because this ratio looks attractive relative to peers. It also has to have the right people, has to have interesting projects, it has to have deep-pocketed partners that can, push forward with the spending, has to check all the traditional boxes. But if those boxes are checked and it looks to be relatively attractive to peers, that to me is a pretty good value proposition. It's talking about prospect generators specifically.
Yeah, I find that very interesting, the way you look at it. And then I have two examples in mind, and I think at least one you own, maybe both of them. Lara, for example, had a really good year. Went from a low of 45 cents to briefly 170, right now 155, I think. So it probably, well, it dropped for sure in terms of expenditures versus market cap. What is the main reason in your mind why Lara did so well? And then another one that didn't do so well, Midland, which really has, I think, $20 or $22 million of partner spending. And I think the market cap is even 25 million or something like that. Good team. I think real geologists, nobody's going to buy it from a hype point of view. It's not a hype company at all. So I think it will only go up if they have some level of results that people are interested in. So how do you look at Midland versus Lara? You don't have to really compare them one-to-one, but in a way of Lara doing really well, why? And are you then selling? Midland not doing well, are you then buying, or is it simply too boring to be invested in something like that? I mean, how do you look at these two prospect generators?
Yeah, so both of them very interesting cases to discuss. Looking at Lara first, in a indirect way, this illustrates the beauty of the prospect and royalty generation business model. But I would argue that Lara's share price performance that we saw over the course of 2024, a share price basically tripled over the course of the year, had nothing to do with partner spend. It had everything to do, firstly, with Simon Ingram stepping in as CEO. I think he brought a lot of eyeballs back to the story. And the former CEO, Miles Thompson, is a core part of Lara going forward as the chairman. And it's worth noting that these two last worked together with Reservoir Minerals, and they're, the band is back together, so to speak. And that is one of the shining successes of the prospect generator model over the past decade. Simon was out of the game completely post Reservoir's exit, and is now back into the fold. So I think his eyeballs brought a lot of attention, but more significantly, and this gets to the beauty of the model, is this has everything to do with their Plan Alto project, which is now 100% owned and far and away their most significant asset within the company. That was under a joint venture with Capstone as recently as October of 2023. And Capstone spent $10 million advancing that project, so pushing it forward entirely on their dime. And due to a board level decision and obligations in Chile, there's a lot of reasons for their decision. They basically handed the keys right back to Lara. And Lara did a really good job structuring that agreement, basically, forcing Capstone to either, put up or shut up. And they decided in that case they were not going to push forward with Plan Alto. And Lara got 100% of the project back in early Q4 2023 when the copper price was closer to 360 or 370 per pound. And Lara's now aggressively pushing Plan Alto forward on a 100% basis. They came out with a resource in Q3 of this year, which I think surprised the market to the upside in terms of the size there. One of the knocks against Plan Alto is that it's not big enough to be significant. And this is not going to be a tier one mine by any means, but they're able to define a resource with plenty of expansion potential of over 200 million tons at a half decent open pittable grade. So the market really liked that. You'll see the share price increased, close to 50% within a few weeks of that maiden resource at Plan Alto being put out. And yeah, they proudly call themselves a prospect generator. They believe in the model. They've embraced it for many years. But one could just as easily argue that at the moment they're more of a developer because they have this 100% owned project that I think is the primary backbone to the current valuation. And Simon has been quite transparent with the market that his goal is to monetize Plan Alto within the next year or perhaps two, to another player within the district. I mean, they're right in the heart of the Carajás mining district in Brazil, the backyard where Vale grew up. And there's a huge amount of activity going on around them. And also a very interesting dynamic where BHP at the moment is in the midst of monetizing a couple decent but not BHP-sized deposits relatively nearby Plan Alto that would make a lot of sense in an integrated scenario. So there's also the potential of a new hungry group coming into the district within the next, say, 6 to 9 months and providing some additional competitive tension for whenever Plan Alto is ultimately sold. So that's kind of the state of play there. In terms of this metric, Lara does not look very, very good in terms of partner spend relative to their enterprise value, just because of this tremendous re-rate that we have. But investors, if they choose to, can apply some nuance here and view Lara more through the lens of a project developer, at least on Plan Alto's their flagship focus, and less through the lens of a prospect generator. Like, I think the better way to think about Lara is what's the value for Plan Alto? Do your math on that, sharpen your pencils. And then, how much is the rest of the portfolio, which includes, dozen royalties, multiple JVs, and 100% ground as well. How much is that worth? So kind of look at that separately, instead of as in one bucket. Midland, as it stands, we don't own it, but ironically, I was looking at it just yesterday. Yeah, I think it looks very, very attractive at current valuation. I think there's slated 15,000 meters of partner funded drilling over the course of 2025. Off the top of my head, their enterprise value is roughly 20 million Canadian, maybe 22 million Canadian. And I think they're projecting 15 or 16 million in partner funded spend over the course of 2025. You can correct me on that if you have that up. So it's not quite close to a 1-to-1 ratio, but it's still quite attractive. Like, as it stands, and I'm willing to share this with your audience, like, your average prospect generator is receiving a 0.33 multiple in terms of partner spend to enterprise value. Basically, for every $1 in partner spend expected in 2025, they're receiving $3 in enterprise value. So anything above that, closer to a 1x ratio means that it's more attractively valued relative to peers. So Midland would certainly fall into that bucket. Really good, dedicated, skilled, well-incentivized ownership there. Lots of news flow, as mentioned. And also like a pretty healthy cash balance. I believe it's at 7.5 million off the top of my head here. So there's no concern of them coming back to market to raise capital anytime soon. So that's a name that's certainly on my radar, but is not currently sitting within the MJG portfolio as it stands.
Looking at your allocation by business model, again, prospect generators are about a third of that, 31%. And then royalties and streaming is 19%. Altogether, that's half of your portfolio right now. Is that where you think you're going to keep and I kind of bundle them together as if you will, non-explorers, or non your typical explorer, if you will. I know there's some other stuff in there as well, but specifically those two segments, is that where you want to keep it for 2025? And is there some kind of a macro driver behind it where you think prospect generators and royalty and streaming companies will do better in 2025?
Yeah, I'd say it's less of a broad-based macro bet. Oh, this is going to be the year of explorers. We're gonna put all our chips on the explorer button, and more to do with specific opportunities where I like the people, I like the project, I like the company structure, I like their valuation relative to expected value. I see catalysts in the calendar that can reasonably be expected to drive a re-rate in share price that just happen to be explorers. So I don't want to say this is a broad-based bet on explorers, even though indirectly it is. I'm comfortable with the weighting. I do note that within the letter, that this is our highest exposure to, explorers plus prospect generators, as you noted, around 55% of the portfolio that we've had since, I think mid 2020, if I'm not mistaken. So we are definitely overweight these earlier stage names. I wouldn't rule out adding any additional prospect generators or explorers to the portfolio, full stop. But I would say that at least when I'm looking at new investment opportunities, I may be a little bit more excited towards later stage names, whether they're later stage development, or even production stage names, than I am to explorers at the moment, just given this already healthy weighting. So I am aware from a portfolio construction perspective that we have gone heavy into these earlier stage business models. Comfortable with where we stand, but not necessarily looking to get that up to 60 or 70% of the weighted portfolio anytime soon. Though that could happen without performance if we see a discovery amongst one of those names. So that'd be a very good problem to have if it does occur.
Exactly. That's what you're hoping for. That's what I was going to say, is that you hope to be overweight, but because of performance. What about, you say there's no macro driver on the segment specifically. Is there a macro driver for the way you pick jurisdictions? I mean, you have the allocation by jurisdiction here as well. North America is by far your largest exposure. I think it's 52% Canada and the United States. Now, with the new president in the US, do you expect that to change? Are you looking to deploy or maybe even pull more capital out of the US?
Yeah, I'm willing to take risk as it comes to jurisdiction within reason. Like if it's the right team, the right project, the right financial structure, and I'm willing to look pretty much anywhere in the world. So I guess I'm less sensitive to jurisdictional risk than many investors out there. That said, I look at it within the context of the MJG portfolio. So if we already have a position focused on Egypt and some decent exposure there, I'm not necessarily excited to add 2 or 3 more Egypt-focused names. Or if we already have a company focused on the Ivory Coast, then maybe I'll be less thrilled to add another position to that jurisdiction. I'm pretty comfortable with where we sit across our jurisdictional exposure. I will say we're quite heavy towards Brazil, which I'm comfortable with. And I should note that both of our Brazil-focused positions, Lara, which we've discussed, and also Bravo, which we've discussed, are both located in the Carajás mining district. So they're in the right part of the country where mining moves forward. There's the prerequisite infrastructure, there's skilled labor, and there's a lot of momentum to push projects forward in that specific region. But I would say that I'm not chomping at the bit to add another Brazil-focused name, as long as our Brazil-weighted exposure is north of 20% of the portfolio. Otherwise, I'm pretty comfortable. I'm not rushing into the United States because of Trump's reelection. I'm certainly not rushing out of the United States because of Trump's reelection. I think it's him coming into the fold is a net positive, certainly for companies with mineral assets that reside within the United States. I think our current exposure to the US, you have the numbers in front of you, but I think we're at 31%, if I'm not mistaken, of the weighted portfolio.
Yep.
So that again was more of a symptom of finding what I deem to be good opportunities, good people, good projects with the projects that happen to be in the United States versus some, broad-based bet on, Trump's reelection or anything of the sort. But I'm certainly comfortable with that weighting. And if there's another new opportunity that crops up where the flagship project or the portfolio projects happens to be US focused as well, I wouldn't hesitate adding it to the portfolio. Like I'm comfortable with a little more US or Canadian exposure, which are kind of our two highest weightings by jurisdiction at the moment.
You said in a recent interview that the Arabian Nubian Shield interests you, and I think you are invested there. I'm not sure. I didn't check how many positions, but which countries do you like over there? And is it because of the Saudi improvements and companies going there, or is it in general the complete ANS region?
Yeah, I mean, I'm fascinated by that whole mineral belt. Though I will be candid. Like we have not seen the uptake in exploration spend and excitement that I maybe would have anticipated 12 or 18 months ago. Doesn't mean that that's not a fruitful region for mineral exploration and development. I still maintain that view. but it's kind of seen its thunder stolen, I would argue, by the Guyana Shield as one example, or closer to home in Africa, the Ivory Coast is seeing a whole flurry of attention, new companies moving in from both Canada and Australia. So while I remain intrigued by the Arabian-Nubian Shield, the geology has not changed since I made that comment in an interview, whether that was 6 or 9 months ago. Haven't seen the amount of companies come into the fold that I probably would have anticipated. That includes within Saudi. Really throwing their arms open towards Western groups to come in, set up shop in country. And we've seen a trickle of junior companies, both public and private, that are keen in on Saudi Arabia, but not to the degree that I would have anticipated. So that's moving a bit more slower than I would have expected. I think a lot of that has to do just with the perception and in some cases the reality of jurisdictional risk there. I was able to visit Eritrea in early 2024, which is just a fascinating jurisdiction. Incredible geological potential there, but also some key headwinds. Tough place to operate, and at least as it stands under the current government there, for as long as that lasts, not a whole host of interested Western parties to ultimately buy out juniors that make a discovery. So you're largely dependent, at least for now, on the Chinese as a liquidity or an exit point if you're operating in country. I've also been to Egypt within the past couple years. Some excitement there in the recent past with Centamin, Sukari mine, which I was able to visit while I was in country, being taken over by Anglo Gold. There are multiple juniors that are pushing forward with exploration programs as we speak. But until now, there's yet to be that game-changing discovery in the eastern desert that can rival Sukari, which is a magnificent asset. I think that probably does occur, and in the coming years, if that does occur, then that's going to bring a lot more eyeballs, a lot more Western money, new vehicles entering country. But until then, probably the groups that are already active are gonna stick with it. But I don't see a whole host of new companies flooding into Egypt in the immediate future here.
On the other side of the continent, when you mentioned Cote d'Ivoire in West Africa, we have seen a big influx of capital. Specifically, the Lundin family seems to be very focused there as of recently, together with the Chinese. Actually, I think it was this week or last week. This week feels like it's been 3 weeks already, but
I feel you.
it's they gave them what, 40 something million dollars, right? A lot of money. And I'm not even sure where I was going with this question, but West Africa, I mean, there's a lot of, it seems like the big money, smart money is flowing in there. Still a lot of hesitancy on the retail side, though. What's your overall take? Do you think you're going to deploy more capital in specifically West Africa in 2025?
Well, West Africa's things are looking good in the Ivory Coast, and I would argue that's one of the hottest mineral jurisdictions within Africa at the moment. Maybe Morocco and Namibia also deserve a shout in terms of areas where we're seeing new capital and new companies flow into. But Ivory Coast is perhaps the hottest as it stands, particularly on the gold front. You rightly note the Montage investment from Lundin and Zijin. But you're seeing success from groups like Awale, Kulu Gold, which is still a private vehicle, is out there and getting very aggressive. A whole host of Aussie names that, if you look at their share price performance over the course of 2024, we're up 100%, in some cases 200% over the course of the year. So Ivory Coast is hot at the moment, but I would argue that's in stark contrast to much of the rest of West Africa, especially the Coup Belt countries, Mali, first and foremost. Guinea to some degree, though it seems like Western parties are still willing to play ball, at least as it stands. Burkina Faso, another example. So I think it's a very mixed picture there, and you have to be quite careful with what countries you're willing to wade into and which ones you're trying to stay away from. I do hope, for the sake of the Ivory Coast and for the sake of the companies that are operating there, that the political situation there remains stable. That is my base case. But sure, there's certainly risk when your neighbors are experiencing coups and jihadist violence, and in some cases both of those concurrently. whether it will cross the border into the Ivory Coast. So that's something to keep an eye on. If you have exposure to the country, if you're considering investments that have exposure to the country, but I'd say so far, so good. You do mention the latest Lundin foray into West Africa. That's with Zijin into Predictive and their banking project in Guinea. So I would just say, from a general sense, that's a good vote of confidence in the country of Guinea, even under its let's just say temporary leadership who took power through non-democratic means. And I think the dynamic of seeing the Lundins team up with Zijin now in two different transactions in relatively short order is interesting. I think it's definitely good branding and credibility from a Zijin perspective to team up with a group of the quality of the Lundin family. And it additionally shows that, at least for gold assets, Chinese parties can still play. I put out a tweet recently and I argued that if either Montage or Predictive were focused on, quote unquote, critical minerals, even if it was very similar economics, similar sized projects, similar locations, it could be a very different story. But the fact that they're both gold focused opportunities, I think it makes it easier for Western and Chinese counterparties to work together and invest in the assets and ultimately push them forward. I don't know where this ends in terms of Predictive. Perhaps it ultimately comes into the Montage fold. Perseus Mining probably has something to say about that. Or perhaps it's a separate vehicle with some consolidation within Guinea, because there are multiple nearby projects of merit that I think could reasonably provide operational synergies with Bankin itself. So at least from where I sit, jury's still out where this goes, but I thought that was a really interesting strategic investment, and predictably, the Predictive share price has performed very well in the aftermath. I think folks looked at what happened to the Montage share price in the weeks and months after that strategic investment, and kind of viewed that as a likely outcome for Predictive, and that's played out so far.
On the M&A front, we saw many big deals last year, billions of dollars of takeovers and mergers. But of course, Newmont also started selling big mines. Do you think that Newmont selling is a bad thing or a good thing for the industry, and will it affect other M&A activity going forward?
Well, I guess there's two ways to answer that. I mean, I think it was a smart decision by Newmont, and they're the bellwether for the space, whether we like it or not. I think what happened post their earnings for the whole mining space, certainly precious metal names, shows that a healthy Newmont is in our best interest. So I think selling non-core assets that don't really move the needle for what's a $50 billion company makes sense. So I like that they're rationalizing operations. But to your point, I think that was an overhang to M&A activity. Clearly didn't stop a tremendous amount of M&A occurring. But I think if Newmont hadn't been selling those assets, there would have been even more activity. And you certainly saw groups that were sitting on their hands and evaluating the Newmont sales before they maybe moved on other juniors or other non-Newmont affiliated opportunities. So I do think it's a positive that Newmont has made what appears to be their last sale here with the Porcupine Complex, this to Discovery Silver. And I think that takes a bit of an M&A overhang, you could call it, off of the space. Yes, they're still sitting on coffee up in the Yukon, but my understanding is that's going to remain the case. So I think for all intents and purposes, they've concluded this program quite successfily. I mean, I believe the total proceeds from these asset sales was close to $4.3 billion. They'd initially guided maybe $2 or $2.5 billion in terms of their target, so they well exceeded that. But I think it is good for the rest of us that process has concluded, and that kind of narrows the scope of potential acquisition opportunities, potentially to juniors or names that we own within our own portfolio. So I think that was an important step to see.
Over on our side of the pond, it's getting interesting as well. Finland, Serbia, even a little bit further away into Central Asia, things seem to be moving. Do you have an idea of where, in terms of jurisdictions, where M&A might be concentrated? I mean, outside of the Newmont thing, but do you expect capital to flow one specific way or another?
Yeah, from a jurisdictional perspective, I don't have any super strong thoughts at the moment. From a business model perspective, I've been calling for some time for consolidation within the junior royalty space. That hasn't really occurred yet en masse. I think it does occur, so that's a theme that I'm looking out for in 2025. We did see the Trident deal with Deterra earlier in 2024, so that's kind of the most recent example of kind of a sub $500 million junior royalty company being gobbled up by a larger competitor. But I would argue that the valuation disconnect between the juniors and the senior royalty companies has widened quite significantly. So I don't think it's the most likely of outcomes, but there is some possibility of a larger player, whether it's the blue chips, the Wheatons, the Francos, the Royal Golds of the world, or kind of that triple flag, a Cisco snack bracket, coming down and gobbling up one of the smaller guys. I think as the valuation disconnects widen, the probability of something like that occurring increases. But I would think what's more likely, and we could see both occur, of course, but is for some of these, sub $500 million junior royalty names. Gold Royalty comes to mind, EMX comes to mind, Elemental Altus, Metalla, Vox Royalty, Ecora. Like a lot of these names have really struggled from a share price perspective, really regardless of how the company's executed fundamentally. And I think some rationalization, some consolidation in this space would be good for everybody involved. So I would love to see, some like-for-like mergers where groups come together at no premium and start to build their market capitalization up towards $1 billion market capitalization and beyond there. And I know there are discussions going on and between the different groups. There have been discussions going on for a long time, but discrepancies over valuations, egos get in the way. Like there are reasons why deals haven't occurred to date. But I do think that changes in 2025, and I do think we see a merger between two of the groups that I've mentioned, and I think that's good for the space as a whole. It spreads G&A out over more royalty assets. It makes the playing field for new deals a little less competitive instead of all these groups trying to outbid each other. And it provides some liquidity for investors to kind of focus on one of these names and push forward instead of having to choose between 5, 6, or 7 groups of similar size. So of the names mentioned, I should note Elemental is a holding of ours, and I did write about it in the letter. But yeah, that's one thing I'm looking for in 2025.
Yeah, egos definitely seem to be a big part of the M&A landscape, and then the premiums and everything combined with it. It's actually interesting to watch. But Matt, we've already taken too much of your time today, probably more than you had wished to look at my face, at least for another couple of months. Thank you so much for doing this. I'll let you go now. What did you come here hoping to talk about that we failed to bring up?
Oh man, we covered a lot of ground. I wanted to talk about royalty companies and prospect generators. We touched on both. Could have gone a bit more deep into the implications of Trump 2.0 on U.S.-based mining assets, but that's okay. We can save that for another day. I know there's already a lot of discussion about that going on. And yeah, in a future call, we can get more into the nitty-gritty of specific holdings within the MJG portfolio that I've at least talked about publicly. Though to be fair, we did get a good discussion in of Bravo and Lara. So I think we covered a lot of ground. I appreciate you guys having me on.
Awesome. Well, thank you so much for sitting down with us, and I'm already looking forward to our next conversation. And thank you to everyone for listening and watching. This was an interesting conversation. Any and all questions for future interviews are, of course, welcome. Please post them in the comments. But I am still going to kind of repeat the warning that I said at the beginning, that everything, everything combined with the warning that I gave you at the beginning is to say that you should treat this program as biased entertainment instead of unbiased journalism, because there will always be some type of bias in what everyone tells you online. They may own shares of the company, they may be a director, they may have been paid by the company, and so on and so forth. Now, this entertainment program specifically is intended only for experienced junior mining speculators, because mineral exploration, development, and mining is a very tough business. Losing money is the norm and should be the expectation, as this is a very complex sector, and the performance of individual companies typically depends on many different things, including geopolitics, macroeconomics, commodity prices, and many other moving particles that are typically outside of anybody's control, and no one can really proceed him, because unfortunately, and believe me, I have tried and I might even keep trying, though I doubt I'll ever be successful. I just don't possess any superior knowledge about the potential direction of any stock or commodity price. And at least to my understanding, nobody out there does. So you should not rely on this program for directional advice or advice of any sorts, as this was a conversation that was general and impersonal in nature between a couple of individuals, none of whom are your licensed financial advisor and none of whom can see the future. So no guarantees can be made about future events, and past performance is not a guarantee of future results. So please talk to a professional licensed investment advisor with a good long-term track record, as well as do more research before taking any decisions by visiting setterplus.com, where you'll find the official filings of the companies that might have been discussed in here today. And if you don't do that, you're highly likely to lose your money. There's a couple of documents that are absolutely obligatory reading for people interested in the space. And that is, of course, the MD&A, which is the Management Discussion and Analysis. And it's an official document that the company publishes on setterplus.ca. You want to look at the financial statements of any company and understand how and why and where they spend money. And you also want to look at the Management Information Circular, which is going to tell you how much money each insider of a company earns in total compensation, bonuses, and everything, and all the other incentives that they might have. It's also going to show you if there are any change of control fees and whatnot. It's a very important document. And then, of course, this is a technically focused business. So you also want to read the NI 43-101 technical disclosure. And again, if you don't understand it, consult with someone who does understand these things. Because if you don't do that, you are highly likely to lose your money. So, yes, thank you so much for listening to this. And I'll leave you with one of my favorite Charlie Munger quotes, which was, if you don't understand it, don't do it.